on 13 rentals, 20 doors, and we were able to stabilize the entire. And if you guys don't understand the terms that I'm talking about, just let me know, and I'll try to explain. Right? I'm just talking the lingo that real estate investing, the way that we talk. So we stabilized the what is it called, the portfolio, and we pretty fast, faster than what we thought. We thought it was gonna take maybe 6 months to stabilize it, meaning that we have most of the units rented. We raised the rents to on most of those properties, and now we're just waiting on the whole portfolio to perform a top performance. So now that we did the 13 properties, we realized that we were able to invest in bigger properties. So it opened up the whole a different horizon than what we had, right? Instead of doing the single families here and there, or maybe the duplex and the fourplexes, we realized that with the capital and the knowledge that we have now, that we're able to invest in multifamilies, apartment buildings in 10, 20, 50 units at a time. But we also know that we cannot do it on our own. And that's why we're trying to get investors and also open up the opportunity to do something with us, something bigger than what we see everywhere. People doing the small houses and the flips and all that stuff. Oscar and I have done rentals before. I've done the flips, but this is another game. And we want to invite you guys to either learn or invest with us if you guys are interested. So it's just listen to what Oscar has to say and be open-minded. And if you guys have questions at any time during the presentation, because you guys are not familiar with the lingo of real estate or with the numbers, let us know and we'll explain. Okay?
Yeah. All right.
All right, guys. So, basically what he said is anytime you have questions, just ask. And then if you take anything out of this, is just know that what we're trying to do right now, anyone can do. You just have to have kind of the foundation and know the pathways. So even if you don't work with us in the future, this is something that hopefully sticks in your brain and you pursue it. All right. So if you guys see the presentation here, this is one of the investments that we're looking into right now. And it's a 1.2 million 24 unit property. And it's basically split into 2 buildings, 14 units and 10 units. Consists of, we're looking for about 460K for investors. Don't worry about the 50K that we say per investor, because that's not exactly where we're drawing the line. If you have less than that, we're cool with that too. At the end of the day, what we're doing is syndication. That's just a real fancy word for crowdfunding, which means you get together, a group of guys get together, we pool money, we buy bigger things. When you buy bigger things, you get more cash flow, so more returns, right? You can do this on your own, one by one property here or there, right? But as we all know, you run out of money, that takes time. I have a few rental properties on my own before I started doing this. At most, I was making cash flow of $500 a month. That's not bad, but it's not the numbers that we're talking about here. So the way this works is there's a general partnership and a limited partnership. There's really no difference between the two except responsibility. General partnership would be my brother and myself, who actually manage, set up the property, push up the rents, and get it forward. Everyone else is a limited partner. The way we structure that is because not everyone can be a chief. Not everyone can be in charge, because then we get nothing done, right? If everyone has a different direction, it's kind of hard. However, what that does mean is in a syndication, if we created an LLC and we did what's called a cooperative partnership, every single person would be in that LLC. The issue and everyone has ownership. The issue with that comes the paperwork and how hard it is to finance on the back end, because now you have, I mean, if we look at count the people in this chat, we have 8 people. Now we all have to get vetted, right? As opposed to I'm already vetted with the private money that I work with, 75% up to 5 million. So it's quicker, we move quicker. And then when you look at syndication, you are still an owner. It's just in a different way. It's just structured to move quick. So you have an LLC. That LLC is owns an asset, a property, and that property is inside of another LLC. Now, what happens is we file. This is where you start thinking huge. We file as a real estate firm, and we file with the Security Exchange Commission. So we file with the government to file it as a security, and what we return to all the limited partners is a percentage own of that asset as a security. So think of it kind of like a stock, kind of like instead of you owning part of the LLC, you own a part of the asset through a security. And I'll show you later on, depending on how much money you invest, you actually get a percentage written on there. So I want to, because I've talked to several people and they're like, oh, well, you know, syndicate, I want ownership, I want this. You get ownership anyway. The only difference is it's the structure that you do it, right? One is a little bit more convoluted than the other. And in the other, you get a lot more flexibility. We get to move quicker. And at the same time, you're still an owner. You just don't have, as a passive or limited investor, if you don't have the time to manage and to go out and to do things, you most likely are not going to be a general partner because you just don't have the time, right? It's hard to do all that stuff. So moving forward with this projection that we have, it's a 17.38% return annually on your investment. Cash flow distributions made at the end of each calendar year. So what this asset is at right now, currently it's 100% occupied. The rents are 400, 600. These are low because these are 3 to 4 bedrooms, and the 3 to 4 bedrooms usually go for $900 to $1,000. So that means we have what's called value add, which is automatically in a commercial asset, you push the value of the property up, and the rent's up and the value goes up. Commercial being anything 5 units and above is different. So it's all based on income. Doesn't really matter the market. And that's the difference between a residential versus a commercial asset. The residential asset is always going to be dependent on the market around it. No matter how good you fix it up, no matter how much income it's making. If it's not 4 units and below, it still caps out with the market. Commercial property, it's not that way. So just so that you guys understand that background. This is a really good neighborhood. There's more information there about it. So again, this is just projections that we have, simple projections. Purchase price, the cap rate, which is the capitalization rate, is what tells you how much, what is your investment return on that asset based on its price. So in this case, and the higher it is, the better a deal it is for cash flow purposes. And then all these numbers here, I mean, if you have any, they're pretty self-explanatory, but if you don't understand gross income or NOI or cash flow distribution, let me know. I mean, guys, feel free to ask any questions. So then there's what's called member preferred returns. So which means whatever comes out of the asset, the first 4% go to all the investors. Any excess cash flow and equity mean anything from the purchase price and above, 70% goes to the members, which means that 30% goes to the general partners. That's my brother and myself. and there's a cash on cash return of 8%. So this is kind of the.
Hold on, Oscar. Hold on.
Yeah.
So because that slide is like very important. Does everybody understand what it all means? Does anybody need to like be broken down so you guys know what we're talking about? Everybody good?
All right. So this is that was year 1 projections, year 5, and this has everything that you need to kind of see for the lifetime of the asset. Maybe I need to make it bigger because I see Maxi squinching his eyes.
Because yes, it's a little small. Yeah, but no, I'll get everything you're saying, and I like the projection for the 1 year. But I mean, 5 year will be probably multiplied times 5, right?
So if you look at it, you're talking about, your cash flow is going up from $36,000. Well, this is all members combined, this projection here, and I can show you individually how it would be. So each member, if you invested the full amount that we need to raise, you get 36,000 first year, 42,000 the second year, 49 the third year, 57,000 the fourth year, 65,000 the fifth year, and that's not counting.
Okay, one question. That would be with the $50,000, partnership, right?
No, this would be with the full amount of money raised. So this is a projection on all the investment made on this property from all the investors. So remember,
Okay.
there's general partnership, and then there's members, limited partners.
The general partnership is like you and your brother, and then we become partners.
Yes, you're limited partners, and this right here that I'm showing is the 70% of the pie that you guys are getting, right?
That's yearly, right? Every year.
Yep, every year. Yep,
Good
and
numbers.
then what's up?
I say very good numbers. Yeah.
Yeah. So
But that's divided by month. So whoever invests on this deal is gonna get a check, and this is the addition, like for the month. We add all those months, or every cash flow monthly, it will be a total of $36,000. So let's say, for example, you're gonna get a check for $1,200, $1,300 a month.
Monthly. Yeah.
yeah, but you gotta think this is everyone. Like if we're raising 460,000, this is if one person came in and raised and put it down 460,000. So that's where it says at the top, you see beginning member capital. That's saying you as an individual, that's what you invested, right? So this is a projection for all the investment, not just an individual. And I'm going to show you like a certain number afterwards. But when you look at the percentages, you're talking about 8%, 11%, 15%, 17% annual rate of return. And when you look at at the end of it all, you get an 86% return, total return on everything. So if you were to invest $433,000, you get your $433,000 back. Then after we sell or refinance, you get $124,000, and then from cash flow of 5 years, you get $251,000. So the total amount that you're getting is $433,000. That's your money back, and then from investment, $251,000 and $124,000. So that's the way it works. And that refinance or that sale, that money, like I said, this is for one person if they invest the whole $400,000. And I'll show you afterwards how it works.
And basically the way it works, and you guys might see, year one year two you get more than year one. So it's not multiplied by 5, like Maxie said, right? Is the thing is that rents get raised every year,
Yeah.
right? And you get the percentage of that rent. If it goes up, you get more money, right? And it always goes up. It goes a percentage up. Then, so you're gonna get the cash flow, the monthly cash flow, which is gonna be a year. It's gonna be, if we get that money, it's gonna be $36,000, right? On year one, you get the cash flow, monthly cash flow. Then you get the whenever we refinance or sell the property at year 5, you get the capital gains of that property.
Yeah.
Okay. So just so you guys understand why the numbers are like that, so you get basically all that type of return on this investment.
Yeah. So that's the end of the broad, picture of what I wanted to show you, of how it's done. But then now I'm going to show you the actual Excel sheet and the numbers. I just want to make sure you guys can see this. You guys can see the Excel sheet?
Yeah, I can see it.
Okay, so essentially this is our, when we went ahead and projected everything we needed to do and how we were gonna make an offer, right? So there's what the marketing package that they offered us, what we found out was more accurate, what we projected in rents for the first year, and then what we offered. So we offered 1.2, and my brother negotiated it down to 1.2. It was 1.4, so we saved about 200 grand there. Moving forward, this property has a gross potential of 234,000. If you look down, we check out expenses. Expenses are usually around 50%. And when you calculate in the loan amount, at the end you have cash flow of $47,000 and what we offered. Off of day one, that is what the cash flow that this property makes, right? So looking at summary and how
Hey, bro, quick question. Sorry. What is the percentage of occupancy right now of the apartments? Out of the 24, how many are occupied?
Right now it's 100%.
100%.
It's 100% occupied? Oh, wow.
Yeah.
Okay.
Yep. So, yeah, and don't, guys, interrupt me anytime.
Yeah, sorry. Just
No, anytime.
So let me explain the occupancy.
that's pretty
right?
freaking good.
So
100%.
The asset right now is undervalued on the rent, meaning that we have an
You could raise
upside.
it.
First of all, we have the upside on the equity because we got a discount already, right? So there's equity on the deal. Second, we have the rents, which is 100% occupied. So as soon as we close, we're gonna get a big check of rents for that month, right? And we have the, like I said, the opportunity to raise the rents immediately, and that's basically what we did with the portfolio that we just bought with Oscar, right? The rents were under market value, and we were able to rent the rents $200, $300, $400. You multiply that times 13. Sorry, you multiply that times 13. That's a lot of money on the month. So This is the opportunity that we have with this asset. Okay.
And I don't want you guys to think that this is the end all be all deals, because to be honest, we keep getting deals that are very similar or even better. But like I said, we can't necessarily move without having more people on the team, and that's what we're looking for. So this gives you a little bit more of how it's structured, how all the numbers work. So, based off the number before, cash flow after debt service for the offer that we put $1.2 million is $47,000 a year, which means that you're having a cash-on-cash return of 11.6, and the investor returns, which is important, of how how we're structuring the whole deal. So remember, member is anybody but my brother and myself, and members get 70% of all returns. We get 30% of all returns, right? There is a fee though. Preferred return members, 4%. So that means before any 70 or 30% is split, the first 4% of all returns go to you guys anyway. So if there was ever anything, you would at least get 4% of any cash flow, any equity that comes out of the deal. However, we do have an asset management fee just for the managers, because we are managing it, and there's a lot of moving pieces. And it honestly, like with the one we just did, it's like having two jobs, man. Like it's no joke. So
Basically, you're talking about 13 units, right? I manage 6, and I'm already going crazy, and I'm
yeah,
just hitting the area.
yeah, exactly. It's not easy. Even though we have a property manager, it still requires you to be on top of what is going on. So it's definitely not easy. And then there's a capital transaction fee, and that's for, we have a financier that deals with private money, and that's where we get our 75% from for our deal, for any deal really, and that's what we pay them pretty much. And then at the end of this, cash flow is $36,000 to members, right? This is not counting cash flow that is to us, because if you see the cash flow to members is different than the cash flow after all the debt service. So there's like about 10 grand that goes to us yearly. If you look at the returns, I mean, you have a annual return of 17, total return on investment 86, and an internal rate of return of 15. All very solid numbers. And then, unless anyone has any question, I'm going to move next into how we project the profit and loss and how we're going to increase rents. Okay, I'll move forward. So here we have assumptions, right? So first of all, raising the rents 6% is conservative, especially when we know we could get them to about $900,000. So right now, as an average for what it's making, it's an average of $815. And then year 2, that's about a $50 raise. Each year is about a $50 raise. When you do that, you raise your gross, and then you ultimately raise your cash flow from $47,000 to $89,000. In that, remember, that is after any loan, any expense. That's just pure cash flow, right? And then here we break it down a little bit more about what the numbers are. And then, let's see here. And then, for example, the 5th year, the total contribution to members is $65,000. And when I say members, think limited partners. And then that's acquisition cost, what we calculated as far as
Okay, go back to the other one real quick.
Yeah.
Okay, so go up. So for the rent, right, where it says year 1 is 815, that's the average. All right, that's not counting the fact that you have, as soon as we come in, we might have apartments that the leases are going to be over, right? So as soon as they're done, then we can raise the rent to top market value.
So
right?
what, for the 6% that what Oscar was saying, or how much higher than you can go when you renew the lease?
So the market rents over there for these properties are $1,000 to $1,100, right? So the $50 that Oscar is talking about increment a year is if somebody decides to extend their contract. So we cannot raise. I mean, it's impossible to raise a rent for somebody from 1 year to the other and go like, oh, now next year you're gonna pay $200 more, right? So this is just being conservative, thinking that we're gonna have the same tenants over and over. But there's always turnover, and it happened to us where we bought 13 houses and 5 tenants had to move up. So immediately, that's actually, even though it's a headache at the beginning, right? Because we gotta market those units and we gotta fix them up and all that stuff. It's good for us. It's an opportunity for us to raise the rents right away. Yeah. You know what I'm saying? So it might take a month or two to break even, but then after that, it's like it's money. So Oscar in these numbers is being conservative when he's talking about only $50 increment, because it could be way more. And you're talking about 24 properties that we're talking about.
Yeah, okay? and this is, I like to be more conservative than to say, hey guys, next year I'm gonna raise it $1,000, right? Because I rather tell you tomorrow, hey guys, you're not getting 15%, you're getting 22% return this year, right? Like, what makes you feel better, right? If I tell you, hey, next year you're gonna get 22%, but you really get 15%, you're gonna be like, what the hell, man? Right? So there's a big difference there. And that's in anything. You want to be conservative. You want to be conservative of your expenses. And that's something we do here. So that's why we have a really, really good idea that this is a good deal, because we've been pretty good on being conservative and analyzing in that way. So, all right, I'll move forward. We calculated acquisition costs, how much it costs to, do all the closing costs and you name it. So this is an important part, the exit strategy, right? So at the 5-year point, what happens is that you look at this asset now, and you basically what you want to do is you're going to look at a cap rate of 9.3, and that's conservative because the higher the cap rate, that means the better the investment for someone. So if we want to make more money, we can actually sell it at a lower cap rate, which means the asset is going to be worth more. So at this point right now, if we sold at 9.3, then the sale price is 1.5 million, right? And we're talking about that we purchased for 1.2. If we actually lowered this at the time and did 8%, this property would be worth 1.7, around there. And then as you go down, it kind of gives a projection of capital, what's available, what's not. But then the important part is right here on the right side, where you look at the, end of year 5, your net operating income is $147,000. The sale price or the refinance price is around 1.5 million, right? And then you calculate everything that's in red, which is the loan balance, the sale costs, because you got to pay a broker fee, right, Maxie? You got to get paid, and then the total equity amount. That's where we say you get 70 and we get 30, right? So first, what happens first is all the capital that was raised is returned to the people that invested. So in this case, it's about 433,000, right? Then after that, the proceeds that are left over is $226,000. So from there, we're talking about a management fee for us, and then there's a proceeds to the members, which 70% of that is $124,000, and then there's $50,000 for us. So there's in total, you guys get $124,000 out of the whole equity piece out of it. So then looking at returns, this is what I was showing you guys kind of earlier on the PowerPoint slide. But what I really wanted to show you was right here. So in this scenario, remember we were talking about how much is to return. So I can tweak this and say, for example, if you put in $50,000,
correct,
you get overall membership is 11.5%, right? That's your ownership piece on the syndication deal and as a security back, right? And then this is your cash flow yearly. And then at the end of the year, you get a return of $29,000 and $14,000. So you get you get your money back, right? $50,000, and then you get $43,000, right? So you get in a total return of 86%, and then annually, and average annual return 17, IRR 15. Cash on cash 11. So all pretty solid numbers. And like I said, from year 1.
Where do you guys get these properties from? Like who gave you this hooked up? Because these numbers are like.
I'm not gonna give you my secret, bro.
No,
No, I tell you the truth. I deal with this all the time, right? But these numbers are solid. Like getting freaking 43 out of 50. It's good. Like in a year. And only for the 3% that you guys are charging as the management, I don't see why not. I mean, I like the figure.
So Messi, just to explain to you, because I knew this question was going to come up, right? our goal is acquisition, right? And we understand that we're at the starting point of this business, right? First of all, we need to build the trust, right?
Mhm.
And not only that, but we want, our goal is, and I was talking to Oscar today, man. It's like uh, our business is not real estate anymore. You know, our business is to create the opportunity for other people, right? And the deals we find, the way I find them is through networking, and then it's just pure negotiation, man. You know, it's like, hey, we have this deal.
Yeah,
This is how
so
much we
from
have.
1.4 to 1.2. I mean, you got a great deal right there. You
Yeah, so
already
it's,
put in equity in the
and
property.
exactly, and they're not anywhere. So I'm not gonna lie to you and be like, oh man, I get this all the time, you know. But it's just negotiation. It's just networking. I've been networking for a whole year, and I met so many people, right? And then we come out with those numbers in order to gain the attention of people like you guys. You know what I'm saying? Hey, you guys are interested in investing in real estate. Um,
I believe that, Herman, what you're doing is terrific because 17%, no bank is gonna give you not even freaking 4 or 5 or 6
yeah,
percent of any,
exactly,
year. So for
exactly,
17,
and we know that. You know what I'm saying? So
yeah,
but in reality, it's more than that. I mean, you're getting, if you invest in real estate, if you invest in these deals, it's not only the cash flow, it's not only the capital gains, but then if you hire a CPA, you're gonna get tax benefits as well. You know what I'm saying? So you're gonna get paid on multiple ways, and it's not only like I said, it's not only the cash flow, it's not only the capital gains. So it's a lot it's a lot that you get benefit. All the other thing is the experience. Just give you an example. Me by myself, if I was gonna buy the properties that we bought last year by myself, I wasn't gonna be able to do it because nobody was gonna lend me money. I don't have the experience as a landlord. So I'm glad that Oscar had that experience because he had rentals before, right? So for some of you guys, I mean, you already have properties, but for some of you guys, it's like, oh, I want to get into real estate and I want to do this and I want to do that. Well, if you don't have the experience, guess what the banks are gonna say? It's like, hey, dude, you don't have landlord experience. You need at least 2 years of landlord experience for us to lend you money on these type of deals. You see what I'm saying? Now we have the experience and we have the network that is going to help us manage all these properties. So in 2 5 years, if you want to get out and do your own thing, you can actually say it's like, hey, I have experience on this. You
Yeah.
know what I'm saying? You have something under your belt to do something bigger, or maybe you find your own deal and we partner up with you.
Yeah.
So that's basically what we want to do, and that's why the numbers are the way they are.
And with that, we, like he said, it's not just about, this is a great deal. It's also with that experience, like you said, you can go and do it yourself. And when I say limited partner versus general partner, that doesn't mean, we are saying, hey, we're going to be doing all the management, but that does not mean that you cannot be as involved as you want to be to learn, right? So our goal is every month we do like another call like this. We update people. You learn what's going on. If you want to be on calls with, the property managers, you can, because you are part owner. There's no way around that. So you can demand out of us, hey, I want to be involved. If you want to be involved and learn how we do this, more power to you. We're all for that. That's where that education piece is where we're trying to do as well, which is, hey, after 2 or 3 years, once you see how this is really done and you want to do it, we have the connections for you to do it. You know what I mean? It's there. And now you can go off, raise your own cash, and we can guide you even through it. Because we're doing it. We after even if we don't do this deal, I know with the 13 properties, once we fully stabilize them, we're gonna offer them because we already know the numbers are there. So, and we already own them. So it will be pretty easy for us to be like, hey, this isn't a projection. This is actually what they're doing. Do you want to invest in these properties, right? So just keep that in mind. And I appreciate you saying that, Mexi. There's a lot of, you got because I get that a lot, limited partners versus general partner, and you guys have ownership. I want people to be involved. That actually helps us stay on our toes, right? And I don't want to let anyone down. I want to make this happen 100%. So yeah, so different projections, of what you're looking at, and just showing you different numbers. I could tweak this all day. If you have an idea of what you want, to me to throw in here, you can tell me. I mean, just
can you go back to the 30,000?
put it back.
And now let me see the figures on the percentage. It's the numbers are there, bro. Like it's good money coming in yearly.
Mm-hmm. Yeah. I mean, the percentage,
numbers
the percentages don't change, right? I mean, the annual return and all that doesn't change. What is changing is your cut of the pie. That's essentially it. And we've made it to the point, where that's why we're giving away. I won't say giving away. That's why we're doing a 70% limited partner member versus a 30% us, because we want it to be attractive for you guys, right? There has to be something like, I want it to be not only ownership are you getting through a security of the asset. It's not like I'm just saying put in this money and you have no ownership. You absolutely have ownership as a security, and it's registered with the Security Exchange Commission, the government. So we're doing this all by the extent of the law, man. Like we're standing up an actual firm. We're locating these assets, and we're returning you what's called a private placement memorandum, which is the security piece of it, which is backed by this asset. So in this case, right here in the line number 2, if you put in 30,000, that security that you just bought would be 6.9% of overall ownership. So there is an ownership piece there. And yeah, so that's pretty much all these numbers that we have. And then if you wanted to see the whole asset, so where's it at? Right here. So this is summary of combined, which is combined means, general partner and limited partner. So this is what it will look like. So in total, this asset is making after we return the capital of 433, it's making $566,000, right? So there's a lot of money to be split amongst everyone. So yeah, I mean, that's the gist of it. What questions do you guys have?
I know I'm the only one. Like maybe he has questions, but I need to be solid with it. Now,
So is this gonna be a 5-year minimum, or it just depends on what happens with the properties during the 5 years, or at least a 5-year minimum?
So no, 5 year is the max, right?
The max?
Yeah, 5 years where absolutely
Capping up.
we all either refinance or we sell, right? At a minimum, what we're looking for is 3 years, because you got to think is we're pushing the price up, right?
Value.
And we can't really tell you that. We can't really tell you until year 3. But that's even at a minimum. But for sure,
it's also important to understand that this is not liquid, right? It's a real estate asset. So it's not like I'm just gonna sell it tomorrow, and it's gonna sell that easy, right?
Right.
So and the reason is because we need to stabilize the asset first. Otherwise, we're not gonna get the full return, and then we're gonna fail you guys because we're saying, hey, this is a projection, right? But then we're gonna sell it in 2 years, and the projection is not gonna be there.
Oh, well, I'm saying it's because 5 years is actually, I thought it was more. 5 years is perfect for me.
I mean, most 5 years,
firms, 5 years is enough for it to mature and give you value. That's what I'm saying. 3.
And it could be less, man. To be honest with you, it could be less.
I mean, 3 is a good figure. It's like any real estate. 3 years to appreciate.
Exactly. No, it could be less, right? Because with Oscar, we had this conversation. It could be less. It could be 24 months. Like for us, with this portfolio that we just bought, right? In the next 2 months, we're gonna have it a top performance where it's like, okay, now we can refinance, right?
Right.
But we cannot tell you guys like, oh, in a year we're gonna have it done because it's not gonna mature yet.
Yeah.
And then we're gonna fill you guys on the investment.
And it goes back to, I don't want to oversell, right? So do I want it to freaking be at its highest point in 24 months? Absolutely, man. But I rather again be conservative and say we're gonna reach that goal at a later time. And then I know if I tell you by year 3, hey Julian, bro, we actually have enough to do refinance right now or sell or whatever, and you guys are like, oh hell yeah. We all agree, boom, we sell and we make the same amount of money. Now we did it in 3 years instead of 5, right? So there's a conversation to have at a certain point, but the goal is 5 years, right? And it doesn't happen overnight. One thing, I want to say too about commercial versus, kind of residential. The reason we focus a lot on multifamily is because there's a lot of reports, a lot of things that show if there's a market downturn, right, people will lose their residential homes, but the one thing that in 2008 through 2012 showed that stayed the same was rents. People went from losing their home to renting in apartments, right? People have to live somewhere, right? So people couldn't own, but they could rent.
Right.
So one of the things, and I'll send you guys some information on that, but one of the things that I found amazing was I was looking at a Grant Cardone video, and he showed literally the rents actually either stabilized or they went up. They went up. And I found that crazy because you hear about so much bad stuff happened during the downturn in 08 and through 12.
You're right on that, because the numbers that you presented, like at 900, 1,000, those are great numbers for those type of areas. Because if you come over here in Jersey, you can find a 2-bedroom apartment for 1,500. Sometimes 1,600.
Easily.
Yeah.
Easily, yeah. So we are on the right track. I mean, I like the projection. I like everything you guys are doing is awesome. Like, I'm on it. Like, I really want to join with you guys, and I have a lot of trust because I know Julian, I know Oscar, Herman, I know you for a long time. So I feel like we're working with family, and the first thing you gotta earn on this is the trust. Just like when I have a client here in the office, I tell I want your trust.
Yeah.
Yeah, I mean,
you're right.
I like it. What do you think, Julian?
I'm excited. But one other question. Well, you still negotiating this, or this is already a done deal, or you are waiting for keep raising the money? Like, we're looking at a time frame of what, like a month to come up with a number?
I think we have
Roughly.
about 3. I think we have about 3 weeks to a month. Where we're at right now is they accepted our offer. This is off market.
Gotta go break the piggy bank,
Well, the next step is to submit what's called a letter of intent,
Right.
and then it's kind of like a soft agreement where they see our proof of funds as far as the 75%, and then after that, we start actually due diligence. I'm gonna be in Ohio at the end of this month. It actually works that the Air Force is sending me for training, and these properties are in Ohio. So
that quinky dinky, bro. Nice for you. Good for you.
So I'll be there, and on the weekend I'll start doing some due diligence. But
get our taxes paid for that trip.
Yeah. Well, my taxes did too, man. So
I got you.
So we're at that point right there. If we get enough cash flow, we'll for sure. And not cash flow, the money that we need to raise, we'll for sure pursue it because we think it's a good investment.
Mm-hmm.
But that's where we say, this is it's not a one-man game.
Right.
If you want to scale in real estate, you need a team, man. I mean, I tried to do this stuff on my own for about 3 years, man. And it's just not possible. I mean, how am I gonna raise?
Too much.
Where am I gonna get 100 minimum 100 grand of my own money? You know what I mean?
Right. Cash.
Yeah. It's not easy. It's not easy. People that do that have rich families. I don't have a rich family.
I feel you.
Yeah, guys. So that's pretty much it. What other questions you got? I mean, that has to be something.
Wait, you said it was 3 to 4 weeks, right, for the letter of intent?
I think that's a good range, right, Jeremy?
Now I'm negotiating the time because they want this as of yesterday. right?
Oh, damn.
So actually, I got the seller texting me. It's like, hey man, we need that LOI. We need that LOI. Now, like
Now
Oscar said at the beginning. Go ahead.
we could always submit the LOI.
Yeah.
And the LOI, we can have about 3 weeks to 4 weeks written into that LOI.
Yeah.
Give us time. You know what I mean? So because like I said, that's a soft agreement. Then right after that, we do a purchase and sale agreement, and that's the one that is, we need to actually go through with.
Hey, bro, quick question. Which HELOC bank do you recommend that you use?
HELOC?
Like, yeah, which bank do you recommend to use to get a HELOC loan?
I haven't.
Like
I haven't
your
got
own
it.
bank, or you haven't got any of those type of loans?
No.
I'll probably do a local bank.
Yeah,
Local bank?
Yeah, local bank would be the best option, because they're always gonna know your property better and give you a better rate.
Gotcha.
But I would look for a mortgage broker, not like a mortgage company, because a mortgage broker is gonna reach out to different companies and get you the best deal.
Got it.
So that's what I recommend, I guess.
Thank you, man. Side note. Thanks.
Yeah, guys. What other questions you got? Rob, you quiet over there, man.
Yeah, I know. Just thinking, so you need, I guess, how many to be able to complete, or how many participants, I guess, I would say, to be able to complete the...
So not about participants, about reaching the goal of at least here that we have now,
Yeah.
433,000. So, I mean, it can be raised little by little. It depends on what
Okay.
what you as an individual is willing to invest, and then
Mhm.
from there, we'll take it, and we won't take it, but we'll look at all the numbers and tell everyone, hey, we reached our goal or we didn't. And that's
Okay.
also where the part of talking to people, right? If you guys
Right.
know of other people, because what that means is if we have a bigger pool and say we
Mhm.
reach our limit, I mean, who says the month after we don't have another one like this? We could essentially
Right.
piggyback deals, right? If other people wanted to invest, it's like a soft commitment, like, hey, if you're interested, stand by, give us 2-3 months, and we'll do this again.
Okay.
And simple as that. So don't worry about participants. I would just say, tell us how much you think, and then we'll go from there.
Okay.
Nelson, you got anything?
No, I'm good. I saw this when you showed me it at work. So
Okay, but do you
Okay.
understand the difference between your still getting? Because I know that was a concern.
yeah. No. I totally understand the difference.
Okay.
Okay. So I wanted to say, right, with the this for probably some of you or all of you, you guys might see this as a big deal, right? It's like, oh my God, it's a 24 unit, this and that. Since Oscar and I started doing this, we realized this is not big at all, and this is one of the reasons that we're doing it with non-accredited. And if you guys don't understand the term, just let me know. Non-accredited investors, right? Meaning that this might be one of the few opportunities that you'll be able to get into an investment like this, right? Because once we get this property, we're gonna be able to go from 1 million to probably 5 or 10 million, right? In acquisition, meaning that for us, it's gonna be more difficult to get investors at the level that we are right now. Not saying that it's a lower level or nothing like that. It's just, it's almost impossible to deal with so many investors at a bigger unit, right? Because right now we have 5 people here in this meeting. That if, let's say, all of you say, yeah, we want to do it and we'll raise it for $100,000, that's a small amount than what you will need for a $5 or $10 million, right? So the opportunity as we grow, right, as investors, Oscar and I with the firm, the chances for somebody like at this level is gonna be really difficult, right? So this right now is a good opportunity for all of you and for all of us to get into this business, because there's only a few companies out there that deal with non-accredited investors, and non-accredited investors is people that don't make $250,000 a year for the last 2 years, or don't have $1 million in assets. You know what I'm saying? So meaning that we're small investors, and right now is the good opportunity as a small investor to get in this business, because you're not gonna be able to get in unless you make, $300,000 a year. So think about that. You know what I'm saying? So this is a great opportunity for you guys and for us to actually grow, because the next deal, it will be easier for us to grow as like investors to get on the next deal. You know what I'm saying? If you guys don't understand what the term is, the accredited and non-accredited, and what the opportunities are, let me know. I can explain it. But just so you understand that
rich, unaccredited, poor.
Yeah, basically. I just didn't want to say it that way. But that's
Let's make it plain terms.
Yeah, because it's in the long term, it's more expensive and more difficult to deal with non-accredited than accredited. You know what I'm saying?
We got less options.
Exactly. So, like I said, is even though I always think abundance, the opportunities, it's like they're limited.
Yeah.
So even though there's abundance of deals everywhere, man, and there's abundance of money, right? But for us that are starting, it's like a limited opportunity, and really seldom when they're gonna show up.
So, he's mentioned accredited versus non-accredited. There's also a big difference in legal wise what we can do and what we cannot do. So I can't for a non-accredited investor, the government protects more. He doesn't want the little guy being scammed. So that's why I have to file with the Security Exchange Commission to let them know what I'm doing. It's very highly regulated. What happens is I cannot market or solicit to non-accredited investors. So if I know so-and-so has money and is willing to, I can't tell him. I could tell him what I'm doing, but I can't tell him, hey, bro, do you want to invest? Because if I tell him that, I'm soliciting, and that's against the law. We can get fined. We can go to jail. But what we can do is we have to establish prior relationship for non-accreditors. So what you say to other people, that's on your own. If you say, hey, bro, like, I think I got a good investment. Do you want to jump in? You can do that all day. But me, as the one that's general partner, I cannot solicit. Now, with an accredited investor, the government does not care at all what they do, because the government knows that they know how to handle their money. So I can market, I can call people like that all the time. And we actually, our financier has a couple of people that are accredited, and we already reached out to them like, hey, do you want to invest, kind of thing. But we can't do marketing. We can't do anything with non-accredited. And that's why also non-accredited investors don't hear about these deals, because you can't outright tell them. You have to kind of be like, hey, bro, you want to hang out? Let's talk business. No, yeah, it's different. It's different. Because I can't flat out go and say, hey, I have this amazing deal with 17 point whatever. If I do that, I break the law. And there's actually big fines, big penalties, big jail time for that. And that's not something we're planning on doing. But yeah, I just wanted to give you guys that kind of perspective of why, as a non-accredited investor, you don't hear about shit like this. It's because a lot of people can't reach out to you. They're not allowed to. So that's also an issue that, as low earners ourselves, we understand there is. So yeah, that's all I got. Guys. What other questions? Anything else?
Good for now, bro. Thank you.
Okay. All right. Well, guys,
I'm good for now.
Okay. Perfect, guys.
I will be texting you though if I have questions, because I'm always overthinking.
Absolutely. So, we'll stay in touch. Just guys, message us. call us, let us know. We'll follow up with you guys and we'll see. Even don't, we're not gonna take anything at heart or bad if you don't. At the end of the day, if all you got from this presentation was education to see what you can do for yourself or in the near future, then that's a win for us, because there's a lot of limited beliefs out there that people have on themselves, and you don't have to just do the one house. You don't have to just do little stuff. You can go big, and all it takes is a team. So yeah, let me know. Let's stay in touch, guys.
All right, man.
Yeah, appreciate
All
it.
Appreciate your time. Thank you.
Appreciate your time. Yeah.
Thank you, guys.
Have a good night.
We'll be in touch then. All right, bro. All right, guys. Nice to meet you. Have a good night.
Hey,
Later.
you
Thanks,
too.
everyone.
Be in
Take
touch.
care, guys.
Bye, guys.